What's going on, guys? Today I'll be talking about a cash secured put. So, a cash secured put is where you sell a put rather than buying a call or buying a put. When people buy a call or buy a put, they want the price to go up or down respectively. So, when you sell a put, you're not necessarily, betting in any direction. You're either betting that you collect the whole premium that you sold the put at, or you're hoping that it does go below that premium price and you get paid to buy 100 shares, which you would have bought respectively. I think selling a put is one of the best win-win situations, and I don't think there's a way, you can necessarily lose. So, let's get started. So, we're here at Fidelity talking about our cash secured put. So, one of the main goals why people should short a put or sell cash secured put is either if they want to buy 100 stocks below the current price or to earn a reasonable return on the cash deposit without risk. The risk with buying a call and buying a call and buying a put is that you can lose all of the money that you put in, right? So, say if you buy a call at $200, if it expires worthless in a week, you're getting nothing back. So, the thing about selling a cash secured put, you want it to either go up, go sideways, or go a little bit down. So there's a higher probability of you, cashing out and collecting that premium. But again, the risk is much lower in a cash secured put, so the reward is much lower. So what is a cash secured put? So as I was explaining on the other section, it's essentially where, say, if you have stock price at like $15, right? And you like the stock a lot. So one thing you have to make sure of is that you're comfortable holding 100 shares of that specific stock. So if the stock is at $15 and the date is, let's say today's date, 1/10 is today's date, and you want to buy 100 shares, but you want to get paid to enter the position, right? You don't want to buy 100 shares straight up, because if you want to alleviate some risk, and get some money off the table, maybe you sell a $12.5 put, and maybe that's 122, right? So 12 days, and you collect, say, $100 in the process, right? I'm not saying this is actually for a specific stock, but this is just as an example. So essentially, if it's at $15 right now, and then you sell this put, so you collect $100, right? But your collateral will be $12,500, because if it does reach 12.5 and below, you have to buy 100 shares, and they assume the collateral would be the stock even if it goes to zero. So that's why you should sell puts on stocks that are very safe and not like very speculative biopharmacy stocks. You have to see what your risk tolerance is in those sections. So I sell 12.5 put. So $100 is a premium I collect. Premium, and my collateral will be 1250. How I see that collateral is 12.5 per share times 100. That's your collateral right there, collateral. So you basically wait until 122, January 22nd, and then you see what you have to do. So say if the price is above 12.5, right? At expiry at 122, then you collect, then you're up $100 because you got that premium for free, and then you can sell another put if you still like the stock. Say if the stock is let's say below 12.5 at 122, you get $100 still for the premium, and then the difference between the actual stock price and the 12.5. So say if the stock price is $11.50, technically you would be losing $100, right? Because You paid, because the difference is $100, right? So you sold a put at 12.5, so you're obligated to buy 100 shares at 12.5. That's a contract that you sign essentially when you sold a put. When you don't have the right to exercise when you sell a put. The person who bought the put has the right to exercise. So basically, if it's 11.5, you do plus 100 equals 0. So you didn't lose any money. If the stock goes, if it's at 11.5 or above, you gained money, which is kind of crazy to think about because when you were planning to buy the stock anyway at 15, it was at 11.5. Now let me give you an example on Robinhood and whether or not I recommend this. So I've done a short put in my Robinhood account where basically I shorted the put, 12.5 put for January 15th, and I started this position on January 5th. So currently it is January 10th. So I have 5 more days to ensure that this put either expires worthless above 12.5 and I collect my full $100, or if it goes below 12.5, I buy 100 shares at 12.5, meaning $1,250, and then we can see what to do from there. So as you can see, we already collected $37 so far because the value of the put has dramatically dropped. I bought it, right around here when it was $1. It spiked up and now it's coming back down. That's due to the fact that Goris Holdings is going up. As you see right here, we see either a flat or an upward trend, meaning that the put will decrease in value. So I can right now, if I really wanted to, I can buy back this put at $63 and like have $37 of profit. I still think that Goris Holdings will go flat or stay up in the future. And even if it does go below 12.5, I would love to have 100 shares at $12.5 per share because I love Goris Holdings. One thing to make sure of is that when you sell a put, you have to make sure it's a company you really like. It's not, a very speculative company. Maybe it's something you want to invest in the future. Goris Holdings is a SPAC for United Wholesale Mortgage, which will be one of the biggest mortgage companies once it's in the public markets. And I really wanted to own the stock. I didn't know how to enter the position, so I sold a put. So there you have it, folks. I really recommend this for people who want to, start looking at it. Especially, I would say the Robinhood interface really explains it well. It shows my break even, my credit per share, my total premium I collected, how many days I have left, and things of that sort. I hope you enjoyed this video. This is part 2 of many to come about how to play options. Please do a thumbs up and have a good day.